Hi, I'm Aoife Devitt, and welcome to another Friday Markets Happy Hour podcast. It is Friday, February 21st, and again, due to travel schedules, is coming to you a day late. But I'm actually sitting here in London recording this, and it seems appropriate given that Europe has very much been on everyone's lips and at the headlines of geopolitical developments in the past week. So, in today's podcast, we are going to do a little bit of a deep dive into Europe, some of the very unique dynamics affecting Europe and Germany in particular, and look at where that leaves us when it comes to geopolitical forecasting and looking at the impact, for example, of any resolution of the conflict in Russia and Ukraine. So let's kick off with our slide deck. I used an image from quantum computing for this slide deck, as we'll discuss a little bit later on. There have been breakthroughs discussed in quantum computing this week, and that is a little bit of positive news, which is perhaps the same trajectory we've been seeing in terms of speeding up tech that has been in the background as the foreground has been clouded with some of the rather continuing chaotic flooding of the zone as regards geopolitical and other political statements. So let's keep in mind that at the background, some of these technological advances are still happening and still give very positive room for optimism when it comes to the tech sector, as well as the speed of our technological revolution. As usual, we're going to cycle through the 5 fingers of the hand: inflation, interest rates, equity markets, geopolitics, and other. And that's where we come up with some of our headlines around the technological revolution. And we are kicking off today by discussing the geopolitical triggering that happened kicked off by JD Vance's quite perhaps not exactly in tone with what the European audience was expecting in Munich. And we're going to do a bit of a deep dive into Europe. We're going to look at the US consumer and to see if it's stirring in the right direction. And we're going to look a little bit around the world to see other economies where rate cuts have been picked up and see what trade responses are being anticipated. If we start by looking at inflation, there hasn't been a headline number to discuss this week, but we know at the background that eggs have been very much on the mind of the US consumer and the rising price of eggs. And we also know that that's no longer unusual. As we can see in these charts, the agricultural commodities have risen quite strongly this year. Some of that will be related to weather events, but mostly a demand supply phenomenon. And that's as represented by the Bloomberg Agriculture Spot Index, and that the wave of food disinflation, which did accompany the years after the pandemic dislocations, is now over. So food, of course, being a staple, it generally will tend to affect the lower end consumer more when food prices rise. So again, more grounds for this K-shaped economy unraveling, but equally likely to be quite a sticky point in inflation going forward. So although we don't have a headline number to respond to this week, it's worth bearing in mind that these factors in the background are still continuing to be very important. And this will, of course, affect the ability of any central bank to take rates down. In terms of interest rates, even though the Fed is committed to being data dependent, and we know that there's still at least one rate drop factored in as it comes to getting to the end of the year, we can see that the implicit Fed funds rate expected for December is not that different from where we are today. So in effect, we have the bond market second guessing the Fed and suggesting that maybe because of this persistent inflation we saw before, rates will not be coming down. As I'll discuss later, this actually sits quite at odds with what we're seeing around the world. We just saw a bumper rate cut by the Bank of New Zealand by 50 basis points, as well as the first rate cut since 2020 by the Australian Central Bank. So clearly, trading partners around the world are starting to look at the potential for an upset of the trade balances and for rising uncertainty in that front. They're also dealing with a sluggish economy in the case of New Zealand. And we can see that that tool will be employed quite readily, the tool of dropping rates by central banks. And maybe will the US be an outlier in this? For the moment, it looks like expectations are that there will not be the same rate cuts that we've seen before. So this all translates into quite a bit of volatility for bond markets. But equally, if rates stay high, it would be good in terms of cash returns and getting a decent yield on that fixed income holding. Coming to Europe, there's some headlines I took here from Bloomberg, which really are quite savage in terms of the implications for Europe of where the New World Order is falling out. We've seen that in the Munich conference and JD Vance's speech, there was a suggestion that he really didn't have the respect, perhaps, that Europe would have been afforded in the past, and that there was a sense that perhaps Europe was increasingly irrelevant. We will show later that defense spending has been lagging in Europe. That's been a long-term phenomenon now, and has been eclipsed by defense spending in Russia, and certainly very much by defense spending in the US. But that is not the only reason why there's a sense of Europe not having a seat at the table. We've had explicit statements that Europe would not have a seat at any negotiation table that Trump was envisaging with Putin and Russia when it comes to the Ukrainian conflict. And it also seems to be clear that many of the new power brokers are Washington, Beijing, and Moscow, and not perhaps any of the European capitals. And we did see this event happening in Saudi Arabia, the peace discussion. So is the Middle East becoming a new power broker as well? Certainly the suggestion of a transatlantic alliance, which would have been in place before, that seemed to be in jeopardy with the tone of the speech. And I will say that there has been some alarm raised in European quarters about the sundering of trust, and that there is no longer the same trust in the US as a global international partner, and how that will have implications just for trade relations and just ongoing relations going forward. So it does also seem to have been some alarm raised at the negotiation tactics already being forewarned when it comes to the Moscow and the Russia-Ukraine conflict, a suggestion that Ukraine will have to live with, perhaps giving up the land that has been gained by Russia, and equally would have to surrender the idea of NATO membership, as well as support from the US. So many of these so-called negotiation tactics already seemingly conceded before the negotiations have even begun. A suggestion again that this was somewhat alarming coming from the Pete Hegseth, the defense secretary. So quite a bit of focus this week on the turmoil that fell out of the Munich conference, what this means for Europe as a laggard. And I would suggest that piled on to the already we know challenging circumstances for Europe around regulation, excess regulation, lack of innovation, and sluggish economic growth. This is all stacking up to be a lot of negatives in the European column. However, as we'll see, markets don't seem to be paying that much attention. Before we come to markets, there has been a focus on the German elections, and actually, despite the fact that JD Vance met with the AfD leader, and there was not the usual diplomatic meeting with the chancellor, we can see that because of the proportional representation in German politics, this is a little bit difficult to forecast, but actually there hasn't been that much movement. It is likely to be a coalition government. The question is how stable that coalition government is likely to be. Of course, more stability would bode well for Germany. We've seen already the consequences in France of a destabilization of the political structure. So a lot of eyes on this German election this weekend to see if there will be any surprise there. But the reason that there is such a focus on that is we know that the consumer sentiment in Germany is probably rock bottom. There has been a very strong low business sentiment, and also a suggestion that just consumer sentiment is also very low. And these surveys suggest that it is the most negative it has been since 1999. It's interesting that some of the set of problems in Germany relate to some of this sluggishness, but it is actually around some of its very conservative fiscal approach. We see that as a percentage of GDP, the German deficit is much smaller than the US or even France. So this is not purely a European phenomenon. It is very much a German phenomenon. They have been what this team deemed the fiscal break. They have been so strict about maintaining a low deficit and about maintaining fiscal spending in check that they have not promoted growth. They've not stimulated the economy. So it is perhaps the opposite of what we may have seen in an overheated or overly frothy economy, such as the US, which has been running a much higher budget deficit. So whether the new government will be able to release this break and provide more stimulus to the economy and let it run a little hotter, this will be a critical piece in seeing the outlook for Europe going forward. The comment about defense spending is well illustrated in this chart. This chart only shows European defense expenditure compared to Russian defense expenditure, and there's a staggering difference in the size of in terms of percentage of GDP, the size of the expenditure in Russia compared to Europe. And this would therefore suggest that should the US abandon some of its transatlantic alliance commitments, that there would be quite a bit of exposure around Europe when it comes to its defense spending vis-a-vis Russia. We do know, of course, that a commitment to spend more in Europe on defense has boosted defense stocks in Europe, as well as boosting the stock market there. When it comes to markets and their divergence from facts and figures, the really staggering phenomenon to watch, and these are two charts which really show the same thing, is just how much Europe has outpaced major global indices since Trump's inauguration. And the Stoxx 600 in particular have had a very good run since then at the end of January, outpacing the Topix, the S&P 500 and the NASDAQ. And we've also seen that this has been happening despite the fact that as the chart that we showed last week, the GDP growth forecast for major European economies is looking quite bleak and would look even more bleak in a scenario of having more tariffs. We did show equally last week that German stocks were selling for only a third of the book multiple of US stocks. So maybe it is some of that low valuation that is factoring in to the strong performance of the indices. But we can also see that whereas the European stocks are very responsive to European political developments. And this chart here shows just how much the Euro First 300 fell relative to the S&P when we had discussion around the French election, snap election called by Macron. But as soon as the US election had happened, that despite an initial drop when Trump's election was secured, the European stocks have done very well. So this divergence in performance from the US is actually, and the fact that the European markets are trading on their own news, I would say bolsters the position that they are a good diversifier. We had thought in the past that everything was contaminated essentially, or at least was going to be correlated to the US direction. If we see European markets continuing to trade on their own news and be able to break away from US markets, this would support the diversification thesis. When it comes to other countries outside Europe and their performance, we can see that China has also started to pick up in terms of sentiment recently. MSCI China has seen an uptick. Looking at individual stocks, just yesterday on Thursday, as Walmart was suffering down 6% because of, despite having strong revenues, a poor and weakening outlook, we saw Alibaba jump by around 9% on the back of a stronger consumer there in China. So even though we've shown in the past the Chinese real estate market looking quite precarious, and that could have very severe implications for the consumer, as far as the consumer spending is concerned, it is coming from a low point, and that's likely to translate into a better outlook for the Chinese stock market. And this chart would suggest that the political risks remains high in China, but that there are opportunities for the market to rally. So interesting to watch here just how these emerging markets and developed markets ex-US are starting to forge their own path. Okay, rounding out the story on Europe, we've spoken about inflation at the very beginning. We know that despite the fact that the Bank of England has cut rates, it knows it needs to kickstart its sluggish economy. Where also just had a UK inflation number come out this week, suggesting that core inflation was the highest it had been in 9 months and was well above the norm that had been in place, the norm being closer to but below 4%. And now we've seen it's just ticking up again, having risen as high as 7%, ticking up again towards 4%. So not good news in the UK, where stagflation seems to be the thing to avoid, but certainly at the back of everyone's mind. Before turning to some miscellaneous items, I think it is important to refer back to that Walmart piece of news that we saw today, because we saw the forecast that the consumer was weakening. And remembering that Walmart is very much at the lowest end of the spectrum when it comes to the consumer and their spending power. It's not an elite store. It would tend to be a lower price point. And I'd say where Walmart perhaps is struggling is its valuation, given it's valued at a higher multiple than other retail stores. But equally, it is clearly going to suffer from competition from Amazon, which is starting to dominate again in the online grocery, as well as just online everything space. So clearly Walmart had maybe had been priced for ongoing growth for perfection, and it did not meet that. But this is just another sign of the consumer getting weaker, We know about the food price inflation. We know about inflation in services and whether they have the same discretionary expenditure. This chart here discusses delinquencies, and this has been something that has been raised. This came from SNBC Nico, but we've seen it raised by Torsten Slock at Apollo, how we've seen just an uptick in delinquencies and credit cards and auto loans. Again, this tends to be a bit of a canary in the coal mine about troubles at the lower end of the spending and affordability spectrum, but still a little bit of concern to see that this is starting to bite. The last headline gets back to where we started, which is around Microsoft claiming that quantum computing had now seen a breakthrough with their creation of a new state of matter, which could lead to vastly more powerful computers, which could do calculations at a speed that currently could, even still at this current state of progress, could only be done by massive amounts of other computing power. So we could be on the cusp of serious change when it comes to quantum computing. Last week, we had a little bit of a dip in that when it was suggested by NVIDIA that these changes were 15 years away at least, and not as far away as 30, but maybe 15 years away. So again, we don't quite know the timeline on any of this. We do know that when it comes to AI, some of that timeline has been brought forward, but still the technological advances should be quite reassuring at the back of there. And that is it for our market share. And that is it for our Markets Happy Hour podcast for today. I will say that one thing that seems to be evident is that we are getting increasing number of concerned inquiries as to what we should do on a portfolio standpoint against the backdrop of this severe amount of uncertainty and geopolitical change that is unprecedented in its scope. I would say our answer to that is we have to remember one of the claims that was made during the first Trump administration and its run up to that. There was a suggestion that we were taking the president literally and not seriously. And I would say that that may be something we need to watch again. What's quite clear from some of the political statements made by President Trump is that this is riffing, essentially. Many of this is unscripted. He throws around terms like dictator, perhaps in a colloquial way, without the wordsmithing that might have been traditionally associated with bureaucratic and diplomatic pronouncements such as this one. So I think we have to look at his communication style, and we know that it is quite casual and generally in the form of quite spontaneous. So on that basis, and he's used to a lot of media coverage, would he expect every word to be wordsmithed and parsed? And we also know from a personality standpoint, when he sees something hits a nerve, he may also repeat that phrase. So it may be repeated from originally being a spontaneous outburst. I think what we're seeing is markets failure to react to that. I think whereby pundits and consumers and onlookers are reacting to some of this riffing. Markets perhaps have long since discounted that it doesn't necessarily be translated into policy, and that it is simply riffing and we shouldn't be necessarily taking it too literally. So I think we need to take it seriously. And what we can say is serious is that we do know we are on the cusp of a new world order in terms of geopolitical alliances. And we also know that there is likely to be a hardening of some of these new centers of influence going forward. This will force areas such as Europe to regroup. We already see that happening. We see more of certainly an allied front when it comes to their liberal values that European would say so-called stand for. And we also know that the commitment around defense spending is becoming much stronger. So just as the Russian invasion of Ukraine galvanized support around NATO, I would suggest that J.D. Vance's speech may indeed be a watershed moment in terms of galvanizing European powers around what it is they stand for. They have committed to presenting a united front, and I think they will know that that united front is one that's stronger and is their last hope for recovering and the economic recovery. So I think that's my last comment in terms of the geopolitical changes we're in and why markets are not reacting to them. So thank you very much for joining us for this Markets Happy Hour podcast on Friday, February 21st, and see you next week when we'll be live in Tampa on Thursday, the 27th. So hopefully you can join us there and listen to the recording. Tampa on February 27th and Salt Lake City on March 6th. Thank you, everyone.